currently experiencing one of the most significant financial bear markets in history. In fact, over the last 40 years, there has never been a time in which the stocks and bond markets have lost this much money. We're not even counting cryptocurrencies right now. Just stocks and bonds together have lost nearly 60% of GDP in the US if you just count the market value lost in stocks and bonds. This is the most significant time of your life if you're an investor and or a trader. You need to learn how to discipline yourself to preserve your wealth and perhaps make money. But most importantly, don't lose all your money in the current environment. We have a very special guest and a very special treat today, Gareth Soloway, master trader of InTheMoneyStocks.com. He's a chief strategist at InTheMoneyStocks.com. Joins us for the first time in our Montreal studio live. Gareth, what a treat to finally be with you in person in Montreal. Of course, we've seen each other in person several times, Miami and Dubai, but in our headquarters in Montreal, what a treat. Welcome to our city.
Hey, thank you, and thank you for welcoming me into your studio. This is an awesome studio.
Thank you. It's even more awesome now that you're here. Now, we're going to be talking about the principles of trading. It will integrate your principles with current market action, of course. You've got 3 principles: personal discipline, understanding psychology, and chart reading, and how to set up the charts for traders. But before we get into that, let's talk a little bit about you. Let's talk about the background of Gareth Soloway and how you became the successful trader that you are today. You've got a lot of quotes here that I want to share with the audience, and some of them sound to me like reflections on your own past and sort of musings on what you could have done better, right? You've got a few wise words I want to share. No one went broke taking a profit. I'm assuming you went broke taking profits. No, I'm just kidding. I'm assuming you didn't go broke taking a profit. That's why you're here. Still standing today. Building wealth is a marathon, not a sprint. Slow and steady makes you a millionaire. And this is one that stuck out to me. Sometimes a loss is a win, and you learn more from your losses than your wins. So I'm assuming then you've had plenty of losses in your past, in your early days, and you've learned from them, which is what helped you build your system today. So without further ado, tell us about yourself and tell us about your journey becoming a trader.
Yeah, so I think the most important thing for everyone watching to understand is that, I wasn't born with a golden ticket. I didn't have a family that was in the financial markets. They didn't own Goldman Sachs or anything like that, right? So it was much more of a kind of a learning environment where I had to do it on my own. So let's go back to high school, right? So high school, I grew up in a middle income, lower income family. We didn't have a lot of money. I remember distinctly the one time a week we went out to dinner was we would go to Friendly's, and kids ate free. I think it was Wednesday nights or something like that. So that's when my family, we could afford to go out to eat, when me and my sister could eat free. So as I was growing up, both of my parents were teachers, and we got to a point where I was in high school starting to think about going to the university or the college, and I was saying, well, what can I do to kind of make my resume look better? And I saw the investment club, and I said, you know what, this looks kind of interesting. And so I joined it, and it just happened to be in the late 90s when we were seeing the dot-com bubble go nuts. I mean, dot-coms were going from 2 pennies to 10 cents to $2 to $10 to $20. And I turned my $100,000, which was fake money, by the way, not real, but I turned it into about, $300,000 in a month. Now, again, was I taking ridiculous risk that I would never take in this day and age? Yes. But the point is, it was addicting. It was one of those things where when you didn't have a lot of money, seeing the type of money, even fake, that could be created was absolutely astonishing. And so right then and there, I said, this is what I've got to do for my life. So I went off to college. I kind of dabbled in a little bit of investing. I had a small amount of money, a couple $1,000s, and I went to get an economics degree. I didn't know where to go to get into trading, but I said, hey, that's a good basis. After college, I worked for MetLife for 1 year. I was low man on the totem pole, so they had me on the phones constantly. I didn't get to do any of the wealth management that I thought I was going to do. And after 1 year, I said, all right, I'm done. And I walked away. I had $10,000 saved at that point, and I tried to go trade myself. I joined a prop firm. They gave me 5-to-1 leverage, and all my losses obviously came out of the 10,000, and there certainly were many, right? So I basically was in a situation where I knew nothing, and I just was trading and losing, occasionally winning, but losing more than winning. And I had to figure out how to keep my account up. So what I did was I worked 3 side jobs. I was a bartender. I was a bartending instructor on the weekends. I worked a catering job, and I saved every last penny I could to put it into my trading account and just keep replenishing. And eventually, over the course of years, making so many mistakes, making every mistake that everyone is making today, has made in their past, I finally started to struggle to the point where I was starting to force myself to learn the charts. And the charts, all of a sudden, it started to show me that patterns repeat. Patterns are representations of humans buying and selling. And human psychology and emotion never changes, right? Greed and fear. That's why you get bubbles. That's why you get massive collapses in markets like we're seeing now. And if you can learn how to read the signals in the charts, you can actually profit from both bull markets and bear markets. So that's really what took me there. And it took me years to kind of get my feet under me to where I was not a losing trader of immense proportion. I would just lose less. And then I became a neutral trader. And then eventually I started to make money. And at that point, I started InTheMoneyStocks.com and started to teach people how to do this type of thing with stock trading and commodity trading and eventually crypto trading.
Okay, I'm going to ask you some personal questions now. Feel free not to answer them if you don't want.
Oh boy.
How much money did you lose before you started making money?
I would say...
You said you started with 10K, but you levered up 5 to 1?
Yes. I would say before I became a profitable trader, I probably lost 300,000, maybe more. Okay. And keep in mind, that's with me working my butt off and putting as much as I could in. So I mean, it's not like I walked in there with $5 million and I lost 300,000 of it before I became profitable. Like this was like a struggle and learning. And so what I always tell people is the market's going to make you pay. It made me pay immensely, right? I mean, I could have become a brain surgeon almost, with that type of money in terms of investing. Now, I'll tell you one thing, investing is way better than being a brain surgeon. Right? You have the freedom to sit in your underwear if you want and trade.
Well, if you make a mistake, you don't get sued.
Right. That's true. Now, you still lose your money, but the point is that if you can get trading down and investing down well, you can do it from the comfort of your home. You can go to a Caribbean island and do it. Anywhere that has internet, you are a free individual that can click a mouse button and make hundreds or thousands a day.
You said you've made many mistakes before, and you've learned from those mistakes. Give us a few examples of mistakes that you've made that you think people are currently making today, because that's what you said.
Yeah, so I mean, and there's so many, but...
Just a few memorable ones,
But the most memorable, I would say, is, so I had finally gotten my account up to about $100,000. Mm-hmm. And there was a stock that was falling. It was a retailer, and it was getting crushed. And I started to day trade. I was like, all right, it's going to bounce here. It's down so much. I don't think I was really looking at technical levels at that time, but I just said, okay, I'm going to go and put a huge chunk of my money in. Well, it kept going down. Well, I had already committed a large chunk of money, but now I was already down thousands and thousands of dollars. And I said, well, it's got to bounce now. So I put more money in, and I used, in day trading, you get 4-to-1 leverage, right? Mm-hmm. So before you knew it, I just had a massive position, and it didn't bounce. And at the end of the day, 70,000 of my 100,000 account was gone, just like that. And wow. I stood up from my desk, and I was kind of in like a daze, right? And I basically just took a walk, and I do what I do, which is a trader becomes more and more logical. And so how do you deal with something like that? Well, I said, I have my health, I have a roof over my head, and I can feed myself. I can come back from this.
If you're at a casino and you lose 70% of your initial principal for whatever game or, event you're participating in, most people will probably just walk away at that point. Unless you're addicted,
I'm not smart enough for that.
Unless you're addicted, then you keep putting more money in. But that's a different issue. Yeah. Some people have issues. But assuming that you're a healthy individual mentally, most people will probably walk away from that and never look back. Yeah. What motivated you to keep going and go back at the trading desk?
So what it is that I was at a point at that point where I was making money generally, and that's why my account had grown to 100,000. But I still made mistakes, right? So I was at a point where if I could learn and not repeat that one, and again, there's always going to be lessons you're going to learn, then you can start to say, okay, well, If I don't make that mistake again and I can eliminate that from my situation, then that takes away the big loss and I can start to kind of continue on my trek to making money. And by the way, let's be clear. I mean, this was something that when I discovered it, there wasn't really another option for me. I told my wife many times over, I'm like, if trading doesn't work for me, I'm just going to go work at like Walmart or McDonald's. That's it. It's like over for me, you know? So it wasn't option. Failure was not an option. I was going to keep going. And at that point, I was at a point where I was almost a profitable trader anyways. So it was just a matter of learning. Can I learn from what I just did there? And I'll tell you, easy way to learn. Number one, and this is what I do to this very day, when I find a level that I like in a stock, number one, using the technicals. Number two, I never go in with a large position to start because the markets are unpredictable. Fear and greed are ruling the market. So what I'll do is I say, okay, what's my full amount that I would commit? And by the way, that full amount was what I bought the first entry on that stock. But instead I say, what's my full amount that I will commit? And I will not go higher than that. And I'm going to do like a 1/6 position. So I take, let's say $100,000, divide it into 6 equal increments. And then that first entry, I only put 1/6 in. Now, what that does is it limits your upside if you're right. If you're dead on, it limits your upside. Yeah. But that's fine because in trading, the most important thing you can do is limit your downside. Always play defensively. That makes you make more money.
You always put a stop loss?
Yeah, I always have a mental stop. Mental. I don't like physical. And listen, for people watching, if you can't deal with those and you can't abide by them, then you need to use a physical stop. If you're going to be away from the computer, let's say you're going on a trip or you're going to be sleeping, you need to use a physical stop. Okay. But for me, keep in mind, I'm a trader. I'm behind my computer pretty much all day long.
I want to go into your 3 principles now because I think that's a perfect segue. So applying the lessons you've learned today, let's discuss the principles that you adhere to as a trader. Number 1, personal discipline. You've got a few bullet points here. Daily structure and routine. Positive thinking is important. Study time, reflection, and personal analysis. So you've developed this framework, obviously, through years of experience. Again, I feel like mistakes have been made in the past where you've thought about it, you've done some self-reflecting, and you thought to yourself, you know what, I need a little bit more personal discipline. I need a little bit more structure and routine. Yeah. Tell us about that story.
Yeah, so number 1, the discipline is an understated part of trading, but it is the most important. Because again, like you said, if you can't abide by a stop, or if you can't abide by kind of segregating amounts that you're putting in investments, then you're going to ultimately get in a situation. You might make 3 or 4 good trades in a row, but if that 5th one is horrendous and you just keep throwing money at it, like I experienced, it's going to wipe out all your gains and then some of the losses. And you find yourself even before your step 1, right? So one of the things to do is discipline doesn't just start in trading. People think out there that you can just walk into your trading room, right, with a couple computer screens and be like, all right, I'm going to be a disciplined trader today. No, you have to be disciplined in life, right? It starts at home. It starts with other things you do. So think about this. How do you wake up in the morning? Do you have a routine that you follow? Let's say some people will go to the gym religiously and say, okay, every day at this time, I'm going to go get a workout in. Or some people will say, I'm going to meditate for a certain amount of time. There's a discipline that starts at home that you have to carry over. So I'm not a big believer that someone that just is all over the place in their regular life being able to get right into trading and say, oh, I'm going to be disciplined now, right? So I think that's important. I also think positive thinking is important, right? You have to learn from your errors. You can't let them get you down. But you also have to look in the mirror, and you don't have to look in the mirror, but I think you look in the mirror and you repeat things like, I will not make that mistake that I did yesterday. Right. I'm better than this, things like that. And then let's be clear, study time. Education is by far the most important thing. If I could go back and if I had education to follow when I was a new investor or trader, right, I would have so many more millions than I do now that it's not even close. Because I just made so many mistakes because I didn't learn first. I basically made the market charge me a educational fee, and that is always going to be more than if you learn from good quality people.
Yeah, they say you can either learn from your own mistakes or you can learn from other people's mistakes. Well, guys, you're lucky because you're learning from Gareth's mistakes.
I hope so.
Don't make the same mistakes he made. I'm joking, Gareth. You're successful today because you've survived those mistakes.
And I do want to say that is like, and for people watching, you don't have to be a high IQ person. I certainly am not. I like to think I'm just in the midst. Maybe I'm low. I don't know. But the point is that you can go into something and you can conquer it if you just put the time and effort in. And I think that's the bottom line, is that you don't have to have a crazy IQ, or you don't have to have parents that gave you $10 million. In fact, by the way, it was almost a blessing that I only had a little bit of money when I started, because if I started with $10 million, I would have lost $20 million. In the beginning. There's no doubt about it. The market is going to charge you money.
You know what? I'm going to get into personality types in just a bit, but that's a great point. Would you have traded differently if you had 10 million versus the amount of money you had, which is $10,000? And of course, and an extension to that question, you had $100,000 of fake money in high school. Would you have traded that amount of money differently if it was real money?
Oh, yeah. I mean, back then, honestly, I'm not sure, because I was just a gunslinger at that point. But
let's say today, I gave you a fake account, $100,000.
Absolutely. One of my principles is that it's a marathon. Investing is a marathon where the people that do it the right way, you don't double your account overnight or in a month, but you will be so much richer than people that are trying to hit a home run right away. Remember, I don't know if you're a baseball fan, but for those baseball fans out there, you have people that are flashy that hit home runs in baseball all the time. They swing for the fences. And then you have the people that are singles and doubles hitters. The best traders are the singles and doubles hitters. Okay. They get to the Hall of Fame. The problem with the home run hitters is that they strike out. Yeah. And you can't, in trading, you can't strike out a lot.
We're gonna get to exactly what you mean by singles and doubles.
Yeah.
And how that translates to taking profits. So that's very important. I think you're talking about taking profits. But going back to the position size, which is coming up, but I'll talk about it now. One of the principles of asset management is that your risk tolerance goes down the more money you manage. Of course, it depends on your client, too. If you're managing for a 65-year-old retiree, that's a different risk profile than a 35-year-old lawyer. But generally speaking, your position size matters, and the larger your position size, the lower the risk tolerance usually. Does that apply for traders as well? Investing and trading is different. I was talking about asset management and long-term investing, but I wonder if position size changes your perspective on risk as a trader.
Yes, as a trader, you absolutely. So one of the things I tell the traders that I work with is that we all have to abide by our risk tolerance levels. So someone that's in their 60s or 70s that's trading with me, they have to obviously think differently than someone who maybe is in their 20s that has a bunch of money that they're just kind of learning with. Each person has to stay within their own zone, because one of the biggest things to fight, and this goes into kind of some of the same type of thing like discipline and psychology, is we all have to fight emotion. Emotion is what is the undoing of an investor or trader. It basically makes them buy Bitcoin at $68,000, and it makes them panic and sell sub 20,000 when maybe that's not the time to do it, right? So you have to look at that discipline, and the way you control discipline is to limit your position size. Like, let me ask you a question. If you had $1 in Bitcoin, and it was going down 80%, would you really care that much? $1.
Right, that's exactly it, yeah.
Right, but if you put $1 million and that was all your money in Bitcoin, are you going to be like checking the price of Bitcoin every single second? Yeah, you are.
Right.
And so you have to find that groove where it's just under the place where you're going to have an emotional response, because emotion, as a trader, you need to be robotic. You need to have no emotion. You're basing your decisions. You have a thesis for trading that is on A, B, and C. And as long as those hold true, then you're in the trade, no matter if it goes up or down a little bit. You can't have that emotional response.
Let me give you this, that this is one of the questions I remember from one of the toughest investment professors back in college, finance profs. He asked the class, I'm going to give you two scenarios here. So scenario number one, you're guaranteed to take a $10,000 profit. I just give you free money. No questions asked. Okay, that's case number one. Case number two, you flip a coin, Gareth. Tails, you get nothing. Heads, you get $1 million. Which case would you pick?
Oh, my Lord. So you have a 50-50 chance in theory.
You get $1 million or nothing. The other scenario is you get $10,000, 100% chance. I'm just going to give you that money. But you don't get the upside of $1 million.
So, all right, so you and your questions, David. So at this point in my career, I would roll the dice and I'd take the coin flip.
Right.
If I was earlier in my career and 10,000 wasn't a lot of money, then I would take the guarantee. Because I mean, again, think about what you can do with $10,000 if you only have 500 in the bank.
So that's a very personal question then,
It's
because
very personal.
If I multiply those digits by 10, if I added 2 zeros, then
Right.
does your answer change?
Yes, it does.
Okay, all right.
Absolutely. Yeah. If you told me 100,000 or $1 million, then it changes.
100? No. I'm adding 2 zeros to both numbers. $100,000 or 10 million, right?
Jeez. Well, it's the same kind of thing in that situation.
Yeah.
But I will tell you this is like, there's a certain point when that first one, the guaranteed one gets to, that you should always be taking the guarantee.
Exactly. If I say I guarantee you $1 billion versus 50 chance of 100 billion, I mean, what does it matter
billion.
at that point?
Yeah.
What does it matter at that point?
For me, that would be a no-brainer, the $1 billion.
So position size matters, personal preferences or personal history, risk tolerance also matters.
Yes.
Where you are in your life also matters. So it's a combination of all these things, which leads to the second principle, understanding psychology.
Yes.
I feel like I'm reading Sun Tzu, Art of War here. Understand your enemy, but also understand yourself. That's what all this is.
You're right.
Understand yourself.
You're right. You have to. So that is such an important aspect of, you have to understand what you're trading, right? And you're not trading IBM or Microsoft or Apple. I mean, everyone thinks that, but what you're really trading are investors and their psychology, their emotion behind, do they think it's going up? Are they greedy? Are they fearful? And you have to be able to watch that and separate yourself out. So what you have to do as an investor is, you're going to start to notice and start to be self-reflective on your personal emotion. When something happens and you're starting to get nervous, say, wait a minute, maybe I need to step back and actually just look at the chart. What's the chart saying? That's going to be your purest form of truth. Don't follow the crazy influencers out there that are pumping, that are creating that emotional response. You need to separate yourself and then actually use it to your advantage. Right? I mean, it's so funny. I use Twitter now as one of my gauges for psychology, and it's a great inverse indicator. So, recently I was talking about oil, and I think even in one of our past interviews, we talked about how oil was in the 120s, and so many people were saying it was going to go to 150, then 200. I mean, I think Goldman Sachs and all these big banks were saying the same thing. And I looked at the chart and I'm like, it's not going there. And I tweeted about that. And so many people, oh, you're wrong, you're crazy. Just by the way, same thing at Bitcoin when Bitcoin was 68 and I was saying the same thing. And I said to myself, all these retail investors are thinking it's going the opposite way. And it's that way of separating yourself out and saying, listen, there's too much bullishness here. Don't fall into that trap. You don't want to be the last person. If everyone else is bullish and then you finally decide to buy, you're buying when everyone else has already bought. Inevitably, there's a top there. And so you want to do the inverse of that when it gets to these extremes. And you have to start understanding human emotion. Like I've often said, if I could train a brand new trader, I'd love to have someone who studied psychology. I think a psychologist would be a great trader. Brand new to the markets, not influenced by Wall Street and all the nonsense they say, but actually someone that just can read human emotion. Yeah,
maybe you'd have too much introspecting time and then you implode because you're confused. But there's a quote here that you wrote here that I like to explore. Emotion is a trader's downfall. Be a robot. Explain that.
So it's exactly that, is that the best traders in the world are the ones that have no emotion whatsoever. All they're doing is looking at facts on a chart, double bottoms, double tops, pivot points, trend lines, and they're just making their decisions based on that. So what you'll often find is that when an asset is running higher and higher, you get a lot of people jumping on board, aka Bitcoin again, in 2021 in November and October. And you have to say, I am a robot. Looking at that chart, is it extended? Is it overbought? Yes, it is. Are people calling out for $1 million price targets a little bit on the insane side right now when you come down to an asset, just of any asset? And then also just look at the hype out there. And the hype was ridiculous. You have to be a robot and say, okay, I see a double top from the April high, even though it pierced, it never confirmed. All these signals were telling us, including institutional unloading right there. I mean, it was a classic institutional signal of selling pressure. And you have to say, all right, no hype from me. I'm going to do what the chart says. I'm a robot. I react to what I see in the chart only.
Yeah, emotions are fleeting. What you're feeling 1 second, you might not be feeling the next minute. So maybe, let's say let's give a practical example, right? So you're trading Bitcoin, dropped 10% in a day, and you're feeling kind of, I don't know, a mix of anxiousness, panic, fear, if you want to call it that. what's your next step? Because I mean, you're human after all. You're not a robot. You feel these emotions. I don't think you're trying to say to people don't feel emotions. I think you're just saying don't act on them, right? So what's your next step? You're panicking right now. You're feeling a little bit of angst. What do you do?
Yeah, so I think what you do is you step back and you say, okay, listen.
You physically step back.
Yeah. I mean, physically and emotionally.
Okay,
I mean, if you need to do it physically, then more power to you if that's what gets you there. But I think you have to be able to start to look at yourself and have that introspective look at yourself and say, okay, yes, I'm feeling fear or I'm feeling greed, but now let me step back and say, okay, what is the chart telling me? What are these factors that I'm seeing in the chart telling me? And that'll ground you. It really does bring you back to earth. In fact, I had someone recently that said, when Bitcoin was trading below 19,000, they were getting close to exiting and just throwing in the towel. Yeah. And then they remembered what I had said and what I had taught them. And they said, you know what, I stepped back. And then all of a sudden, before I knew it, Bitcoin had rallied back up. And thank goodness I didn't react to my emotion. Right. So it's that ability to look at yourself and to start thinking more robotically. And by the way, emotion's great in life, right? And love and empathy, sympathy. I mean, those are all great times to have emotion. Just in trading, it will inevitably work against you. And I'm telling you, there are bots, there are algorithms that the institutions have that know max pain levels on both sides of the market. And they will push the market to that level, knowing that if we can get Bitcoin or Apple above this level, we'll get a bunch of people to either jump long, or if it's down to the downside, we'll get them to exit the trade, and then we'll just whip it back the other way. I mean, it's used against investors. They have to get control of their emotion.
Yeah. I'm just curious because we're talking about personal discipline here. How do you separate your trading life from your personal life? Because I mean, you can't be a robot to your wife, to your friends and family. I mean, you're going to be a social outcast, right?
Yeah.
I mean, but you're so grounded in your work. You live your trading. I'm just, where does that delineation happen? How does that happen?
So I will say this, is that I have done it for so long and been kind of robotic in trading and very logical that there are periods where my wife gets a little annoyed at me. I'm not gonna lie. She says, well, you just come, I'm coming to you with, wanting this emotional reaction, and I'm very much like, well, this is the way it is, and this is this, and let's look for this, and I mean, she's there. So there is bleed through. Yeah. It's impossible when you live and breathe trading and you get to this point. There's going to be bleed through. But at the same time, I do believe it can help you in life too, to kind of not get over emotional.
Absolutely. I mean, the inverse of that is obviously you're too emotional, and that's obviously not great for your personal life as well. So I feel like this disciplines you in many ways. Yeah. Finally, number 3, chart reading, trading setups. I'm just going to go through the bullet points here you have prepared. Keep things simple is the first one. Learn key technical candle setups. Analyze risk versus reward, and focus on multi-factor trades. All right, we don't have a lot of time left, but let's go over all of them quickly, and then we'll move on to the Q&A segment of our program here. Keep things simple. Nothing you do is really that simple, Gareth. You make it sound easy because you've had years of experience and you've lost a lot of money before you got. But what do you mean by keep things simple?
So keep things simple is like there's a million indicators out there, right?
That's it.
I use moving averages, Fibonacci, use a candlestick chart, a couple of other things, that's it. I don't put a lot of other things on the charts because the charts really will tell you what is going on. Remember, every time a candlestick chart forms, it's telling you something. It's either a reversal candle or a bottoming tail or an engulfing. I mean, there are so many possibilities that can enlighten you into what is actually going to occur. And remember, you always want to stay one step ahead. You don't just want to say, oh, well, this is happening now, so let me jump on board. You have to think 2 steps ahead. So those candle formations are telling you essentially what smart money's doing. Like a bottoming tail is telling you, charts at the low, it's flushing out. Oh, wait a minute, it reversed on heavy volume, creating a bottoming tail. There's money buying in, and that's usually a reversal signal. So you want to really start to just eliminate a lot of these other indicators that you can put on your chart. I've seen people use charts, and I look at them, I'm like, I can't even see the chart because there's so many things on it. Keep it simple. Everything you need to know is in that chart. You have time counts, you have the confirmation signal. These are all things that I've created on my own and kind of will be teaching. But yeah, it's amazing how much information you can gather from just a very, very simple chart.
Okay. Analyze risk versus reward. Can you give us an example? How do you do that?
Yeah, so that's a huge one. The best example would be let's say you're at support. But so you want to buy, right? We want to buy support, we want to sell resistance. If I look at the chart and I'm saying, well, it's at support, and if it bounces 50 cents, it's going to slam into the 200 moving average. If it breaks this level, there's no support until $5 down. So you have to, as a trader, say, okay, well, even if the trade is an 80% success rate trade, so 8 out of 10 times I'm going to win it, is it still worth it to make 50 cents when I could lose 10 times that and lose $5? So there's always this kind of analysis where there'll be some times where it's a great setup and the risk reward will be only subpar. And I'll just say, you know what, not worth my time. And the one thing traders and investors need to understand is that there is always another trade. So people, you know, beginning investors or these retail investors, they always feel like they always have to be in trades. They need that adrenaline rush. By the way, that adrenaline rush is emotion, and you don't want that. But there's always another trade. I've never been in a situation where I'm like, oh, I didn't take that trade, and there was never another trade. I guess that was it. Sorry, I'm done trading. You know, like, there's always going to be more trades for you to take. So be patient, trade less, makes more. Another huge concept that I try to get across to people is that when I was starting out as a trader, I would day trade like 20 times a day.
Right.
And I would generally lose, and the commissions would just stack up, and I would end up costing myself 500 in commissions. Back in the day, commissions were more. But as soon as I started to trade like 2 or 3 times a day, I made way more money.
You don't scalp like intraday scalping, like it goes up, I don't know, 0.5%, you take profits, wait again, 0.5% take profit. You do that? I
do that, but I'm just so disciplined, and I think this is important, is that I don't want to be in a stressful situation because that's where emotion comes up. So I'm so strict on the criteria I look for, and this is all stuff that I teach, is that I only probably in an average day, maybe 2 day trades. And those might be in and out in like 3 minutes or 2 minutes or 1 minute, but I'm making $500 to $1,000 on each one.
You were just trading pre-market. Can you share with us what you were doing?
Those were swing trades. I was monitoring some swing trades as I am in positions, but yeah.
All right, cool. Can you reveal to us what positions you're in or no?
I was looking to buy a little bit more WBD, which is Warner Brothers Discovery, as with the Game of Thrones coming out in August. I'm interested in that.
We're gonna. That's an interesting concept. Yeah. One of the things I like about you as a trader, Gareth, is you're not just technical. You do incorporate real life experiences and some macro and fundamental research into your trades. Case in point, just that. We have a few minutes left before we move on to Q&A. So you were talking about the singles and doubles example when you the baseball example. You're talking about better to back singles and doubles and to aim for a home run every single time. How does that translate to taking profits?
Yeah, so with singles and doubles, they're just that. Is like, you know, one of my favorite players was Wade Boggs back in the day, and he was always a singles and doubles hitter by default. Occasionally, 2-3 times a year, he hit a home run. And I always want to make people aware of that. When you're trading for the small amounts, you'll wake up one day and your stock got bought out, it'll be a home run. But you can't be swinging for that. Because if you look at those hitters that swing for home runs all the time, they're always striking out. And in trading, you can't do that. It's too detrimental to your portfolio. So what I like to do is I like to basically look for trades that I'm going to make approximately 10% on as a swing trade, sometimes 15, but again, those would be considered singles and doubles to me. And then just naturally, I'll find those positions that or just naturally I'll be in one that turns out to be a 30, 40, 50, 60% winner. But it's the consistency of being able to get 10% out, and you just do that over and over again. And if you can get an 80% success rate, win rate, right? Then that takes care of itself, and you make so much money over the longer term. One thing I'll say, I know you want to say something, but do this example. One of the most powerful examples, take a calculator and say you start out with $25,000 and do 25,000 and then multiply it yearly, compounding by, let's just say, 25%. So just making 25% a year. See what that number is after 10 years versus if you were a home run hitter, 1 year you made 100%, the next year you lost 50%. The next year you made 100%, but the next year you struck out and lost 50%. And what you'll see is after 10 years, you still have $25,000 if you were swinging for home runs. If you didn't and you just had compounding 25%, you're well over, you're approaching, it's not too far away from $1 million. And so it's the long game. It's the long game. Small investors are always into trying to double, triple their portfolios because they think they have small money. They have to get to big money. It's the best way to stay poor.
That's Einstein's quote. Albert Einstein, he said, the most powerful force in the world is the power of compound interest.
Yeah.
So as long as you can continuously compound your returns over time, you're going to be very rich. I want to close on this statement here on my last technical question for you, and then we'll move on to the questions from the audience. Jack Schwager, trader and fund manager, he wrote Market Wizards. Great tool book for any aspiring trader. Now he was asked by basically what he did was he asked he interviewed a bunch of traders, and then he basically just compiled all his interviews into one book. And somebody asked him what was your most memorable interview that he's done, and I'm just going to read this paragraph. He said Bruce Kovner, the founder of hedge fund Caxton Associates, he had the single most important advice I ever received. And you said something similar just now. He said, know where you will get out before you get in. Yeah. This is going back to what you said about your exit strategy. Mm-hmm. So tell us about your exit strategy.
Yes.
What set up for us your mental framework for what you're thinking about before you even place a trade.
Oh, that's great. So the way I go into a trade is, number one, I'm looking for factors, and factors would be technical factors. It could be something else as well, but generally focused on the technical chart factors in any particular trade setup. So what I'm doing is, number one, I don't trust just one factor. One factor, I can tell you right now, 60% chance of making money. To me, I'm not in it for 60%. If I want just slightly lower than 50-50 odds, I go to the casino with my buddies, we get drinks, we have a great night. I know the odds are against me there. I want 70-80% success rate trades. So I'm looking for 2 to 3 factors. And again, it could be a bottoming tail at a major support. I mean, what I teach is all about these different factors and putting the pieces of the puzzle together. So I'm finding a trade that fits those criterias. Basically, it gives me a thesis. As long as that thesis holds true, I stay in the trade. That's the most important thing. The other thing we mentioned earlier on is, even if you're buying at a specific level, understand that it could pierce your level by a little bit. So don't put all your capital in that you're going to devote to that trade right at the first start. Mm-hmm. But leave a little bit, because dollar cost averaging, there's a reason why people like to do it. It makes a lot of sense, gets you a better overall average. And again, when you go all in at one level, your emotional reaction is going to tempt you to do the wrong thing. So the bottom line is 2 to 3 factors on a trade. Know the position size ahead of time that you're willing to commit. Mm-hmm. All right, that is so important. You can't go in just saying, oh, I'm going to throw 20,000 here, and then, oh, darn, it went behind me. Now I don't feel comfortable with it, but now I got to do another 20,000. It's like, okay, the max I want to do, 20,000, so 5,000, 5,000, 5,000, 5,000. Get into that position that way. Keeps your emotion down. Reduce emotion, become a robot, and literally follow the charts, and you can profit for life.
Mm-hmm. Great. All right. Perfect. Thank you for sharing your thoughts. We're going to move on to the audience questions now. All right. We've got a few questions come in from the audience now. We're going to start with something from PlayDaws. Why are you so against leverage trading? Yeah, Gareth, what's wrong with leverage?
I love the first question. So I would say, I'm against leverage trading because if you've seen what's happened to Bitcoin and the crypto markets in the last 6-8 months, you basically have no money left in your account. If you look at Voyager, who over-leveraged themselves, Celsius over-leveraged themselves, and again, that's the result. So I think especially when you're a newer investor or trader, you don't want to use leverage. There's a point where...
There's no audio.
Okay, so there's a point where at some point, I think 2-to-1 leverage is okay, but I've seen it where smaller investors generally use more leverage and then they go broke faster. And you need to learn how to walk before you learn how to run. And I think that's key, is that, you look at a lot of hedge funds, and by the way, hedge funds blow up all the time with leverage as well, but at least they know how to run at that point. Small investors, it's all about get rich quick, and that's the problem. When you use leverage, then it's going to end badly.
Okay. Moving on to, on that same note, so one question for Gareth. Seeing Celsius filing for bankruptcy, are other major exchanges at risk? Is it wiser to move crypto into cold wallets and fiat back into the bank accounts?
So I think you have to look at the brokerages and the exchanges, right? So I think there are some that are safe, some of the bigger ones, but I would definitely caution against any of them that are not super wide stream, that have taken too much risk. And again, people know more about this than even me in terms of, how much leverage or what were they giving individual traders? Were they offering, 30%, 50% type returns that were just ridiculous even in this day and age of rising inflation? And I think you have to look and say to yourself, did this player show me that they were smart with what they were offering, or were they taking too much risk?
Okay. And what would you do for your own account?
I don't with crypto. I don't use leverage because crypto is notoriously wild.
Do you use a hard wallet?
Oh no,
Hard
I don't.
wallet?
I don't. But then again, keep in mind,
hold it,
one of the things to keep in mind is that I don't put a ton of money in cryptocurrency. All right. So the way I have it structured is 10% of my assets go in my crypto portfolios, and by the way, I spread them around too. That's one of the ways I mitigate risk. So I have literally 3 different, I might even have a 4th that I've recently opened where I put money in those players to be utilized in cryptocurrency. So number one, it's only 10% of my money that goes in there, and then it's spread amongst multiple. So if one does happen to get hacked and I lose all my Bitcoin, or I lose something like that, or if they go insolvent, it's only a small percentage of even what's in my crypto portfolios.
Okay. Let's go back to some other questions from the audience. So what is short time trade in Gareth Dictionary? The minutes, hours, or days?
So my quickest trades are probably seconds to minutes. Those would be day trades. Those are quick scalps where you're playing counter trends. So a stock might fall into gap fill. I jump into it and we're out for 20, 30 cents very, very quickly. And that can happen literally in seconds, Generally, my midterm holds, or let's take it one more step. So that's day trading. In swing trading, a short-term hold or a near-term hold would be days to weeks. Midterm would be weeks to months, and long-term would be months to years.
Mm-hmm. Okay.
So by the way, what that tells you is that I'm not a big believer in long-term investing. I just am not. I've seen too many bubbles. I saw 2007, 2008, 2009. I saw 99, 2000, where long-term investors basically lost 60, 70, 80% of their portfolios, and then the emotion of it caused them to usually get out of the market at the wrong time. So I've made much, much more money by playing shorter-term moves in markets where a stock will pop 10% or 20%. I take my profits. It corrects 10, 15%. I rebuy in if I still like the thesis, and I can just do a rinse and repeat many, many times over. In fact, recently we've done that with Carvana, which, by the way, I'm not a huge fan of the company. I don't necessarily know if they'll survive long term, but the stock literally has these 50% bounces off of these $20 levels. Stock's down from like 300 and something. And so we're just swinging it. We make 20, 30%. We do it again and again and again. And you can just generate so much alpha that way.
Mm-hmm. Okay. Here's a question that just came in. When will the markets bottom? What price will QQQ hit?
Wow. So I think the NASDAQ, this year outlook has us going down to the pre-COVID highs. I don't remember exactly what price point that is, but I think that's your target for this year. Doesn't mean we're not going to have bounces. I think right now the US dollar is at a point where it is going to come in. It's into such major resistance. I've done a lot of buying of commodity related plays like Freeport-McMoRan, GLD, SLV, GDX, because I do expect the dollar to pull back, and even Bitcoin. That should help Bitcoin since Bitcoin can be traded in US dollars. So I think for the most part, you look for those type of moves in the near term and get some money in the bank.
Okay. Question is, how low does Bitcoin, BTC, need to go to clean out all the crappy altcoins? This is a question from Alicia Zorzetto.
That's a great question. And the reason it's such a big question is because we are facing these unprecedented times, right? It's the first time in Bitcoin's history where we have this aggressive Fed moving with these huge rate hikes, and we have inflation at, 8, 9, 10, 11%. And so you could go back in previous bear market cycles in Bitcoin and you never had these issues. So it means that if anything, this is going to be the worst down cycle we have ever experienced in Bitcoin. I do think it bottoms out probably between 12 and 18 months from November, so November through early 2023. But I do want to be clear is that if you compare this to the dot-coms, you have to think that it could take a while for us to get back to 68, 69,000 in Bitcoin. It took quite a long time for the NASDAQ to get back to the pre-dot-com era highs. I also think that to wipe out the nonsense, you may even have to go below my low-end target of around 12,000 on Bitcoin. I hate to say this, and I don't mean to scare anyone. And by the way, in all fair disclosure, I own Bitcoin that I'm going to be holding from around 19,000, right? A small position I started to inch in because I don't know where the low is going to be, but I'm preparing for the worst case scenario of 3,500.
Wow.
Yeah. And again, just to be clear on that, as a trader, and this is going back to education, if there's one thing I've learned in my trading career is that you prepare with your targets, but you also prepare for a worst case scenario. You need to look at your worst case scenario and figure out, how am I going to react? What am I going to do if this does happen? And play defensively.
They say that, not they say, some people have said that it's easy to become a millionaire during a market downturn or during a recession. That's how you build your wealth, they say.
Yeah, so I've always gone on the assumption that, you have a bull market, that's where you get a lot of millionaires, like crypto millionaires, right?
Yeah.
It's usually the opposite, because bear markets, first of all, we're generally programmed as humans to be bullish, right? I always like to say this, but if you're depressed, if you're kind of down on life, what does the doctor do? They give you medication to make you positive. So inherently, human beings are positive. We want things to go up. So when they don't go up and our bullish feeling, that greed, that amazing feeling of, oh my goodness, I'm going to make so much money, doesn't work out, that's usually where people give up money. Now, as a trader, yes, you're right about that. Trading, where you're buying the dips, you're selling the rips, if you can read the charts, you can make a lot of money. In fact, this has been my best swing trading year, I think, of my career.
Wow. Okay, let's move on to another one. Playdos, another question from Playdos. Hey, Gareth, what's your favorite go-to, most trusted TA indicator if you can only pick one?
Wow. All right, so number one, as a trader, right, you have to, you're asking me about picking one, and I will pick one. But in general, you never want to make a trade off just one indicator. And the reason you don't is because what if the next indicator you looked at is pointing in the opposite direction? So what I like to do is I like to find 2 or 3 factors, I call them factors, that all point in the same direction. That usually gives me that 70 to 80% success rate on a trade. Now, with one factor, I would generally say a sharp drop into something like the 200 moving average or a Fibonacci level retrace after a big move up, and you buy the pullback. Essentially, you notice the trend is up, you get that ridiculous up move, you get a sharp pullback as people kind of panic and dump, take profits, and then you buy that major support. And notice I'm mentioning the 200 moving average, not the 50, not the 20. 200 is really the mega, the behemoth of moving averages.
Suppose something breaks below, you and I have talked about this several times in our regular interviews, but suppose something breaks below the 200-day moving average. Is that a bearish or bullish signal? It could go either way, right?
So there's one thing that I look for with any level. So it could be a trend line, it could be a moving average or anything. If you break below, number one, that could be a fake out. So a lot of investors put stops right below key levels. Well, guess what? The algorithms know these things. So what they're going to do is they're going to pierce that level, knowing that your stop is going to get triggered, you're going to get out of your position, and then oftentimes they'll rip it the other way. Great example right now, Bitcoin. Bitcoin has multiple times pierced the 2017 high, never confirming. What I use as a confirming signal, which is something we'll talk about in a little bit in something that I'm going to be teaching. But basically, there's been these whipsaws, and then it goes right back above that 2000. So basically, you have to watch to see, does it confirm below that level? If it confirms, then it's a real breakdown. If not, I don't get out when it pierces a level like that until it confirms.
Okay. Moving on to another question now. Gareth, can you please write a book?
I'm too tired to write a book, but almost as good as, even better than a book. I do have the educational stuff that's coming out, which we'll touch base on later.
We're going to touch base on at the end of the interview. I mean, people have been asking some of the questions for resources for beginners. Do you suggest, besides what we're going to talk about, do you, reading material? Basically, how did you learn? This was before YouTube, right? You grew up before. There was a YouTube university back then.
I was, when I started, it was AOL dial-up and $20, $30 trades on E-Trade, that in and out, $20, $30. So it was pretty hefty. But basically, what you want to do is you need to build a foundation. So again, it's understanding the 3 aspects, which I kind of covered before, the 3 principles, which is psychology of human nature. You have personal discipline and emotional control. So those are two things you have to do. And then really the next one is just learning the basics of a chart. What is a candlestick? What is a topping tail? What is a bottoming tail?
Right.
Just the basics to build that foundation. And then what you really need to do is you need to find people that know what they're doing, that have a proven track record, that teach well, and you have to follow them. And I wish I did. Looking back on it, again, it was pre-YouTube when I first started. I didn't have those assets. Twitter wasn't really around at that point. I think it was, I don't know, even before Facebook, even before MySpace, Friendster, back in the olden days. So I mean, again, I had to do it on my own. I hope that me talking about it helps people, jump a lot of that learning curve.
And guys, I'm not suggesting that just because we have the technology these days that more information is necessarily better. There's a lot of noise out there that you've got to sift through, and there's a lot of people giving bad advice, a lot of scammers and fakers out there.
Can I make a comment on that? Because I think that's so important. Is that one of the biggest? It's a positive and it's a negative. But social media, because things get amplified. I mean, before social media, you basically had the Wall Street Journal, you had some things with, by the way, we're not the greatest either. But now you have social media where people called influencers, by the way, the term influencer, to influence. So there's a purpose for them, and you have to really be careful. So you can find great information on the internet, but you can also really get suckered into things, whether they're pump and dumps or whether they're just people that are just trying to talk up their own book and push Bitcoin higher and stuff like that. So be careful out there.
Definitely. I mean, don't get on the wrong side of the trade. Don't get sucked into a pump and dump. You could lose your money or go to jail. I don't know what's worse these days. Do you keep your money if you go to jail? Anyway, that's a discussion for another time. Another question. We're going to get into the market questions now. This one's from Giorgio. Thank you for answering my question before. May I propose another one, please? In the case of military escalation in Taiwan in 2022, what would be the safest asset for Gareth besides the U.S. dollar?
Wow, so that's a good question. So I have been looking to accumulate, and I have accumulated some stocks in China, some in the Hang Seng market. It's my belief that will be the next big bull market. I know a lot of people would disagree. The one caveat, like you're saying, is what if China invades Taiwan, and what are the repercussions? So certainly it's a very calculated percentage of a small amount of a portfolio. But I do think that the valuations there, the fact that the Chinese government is much more apt to stimulate and continue to stimulate to keep people happy there, it makes it a much more intriguing investment opportunity. I also think South America hasn't had a big run. I mean, what it's interesting is I look at these charts, right, and I look at like Brazil, the Brazilian ETF, and it's down at levels. It's trading at levels that it was trading in 2010. You look at the Chinese market, same thing, levels it was trading in like 2010, 2008. Yet you look at the U.S. markets, and they've gone absolutely vertical until this year, and they've outperformed. Well, money managers were only investing in U.S. They pulled all their money out of a lot of these foreign markets because this is where the money was to be made, right? Well, now you're seeing a Fed that's not as accommodative. Money's going to start to rotate to other areas of the world. So I think gold, I think commodities in general will do well, as I think the Fed will eventually come back and start printing again. And then I think other foreign markets are very, very interesting.
Interesting.
And by the way, it doesn't mean that there's no bull markets in the U.S. markets either, right? You just have to be a little bit more careful and pick the right plays. It's not just like throwing a dart at a board.
Oh, that's exactly it. And just out of curiosity, how much of your trades, percentage-wise, roughly, are macro trades? Like you place a trade in advance of a potential event or a scenario that you've just described. I know you're not a long-term investor. You've explained that, but let's suppose you think that there's a small chance Taiwan's going to get invaded in this case. Would you place trades before that event?
So I don't mind placing trades before an event because I never know if that event is really going to come true. What I've learned is that investors, they say, well, what about this? Like, what about the CPI? What about the PPI numbers, right, that we just got out? And both of those showed incredible inflation, yet instead of the market dumping out, the market actually rallied both days off their lows, and I think we're even higher today substantially. So you have to be careful about news where smart money knows the news ahead of time and they're positioning 2 steps ahead. Investors listen to the news and react to the news. And that is a huge issue with smaller investors where they're reacting to what the media is talking about. The smart money's already positioning 3 steps ahead. And so you have to always think outside of the box. So for me, let's talk about the CPI numbers. So CPI came in hot.
9.1%.
Yeah, 9.1%. And all of a sudden the market dumped out. Meanwhile, I'm sitting there thinking 3 steps ahead, like I hope the big money was, and saying, well, look at the chart of lumber, look at the chart of gasoline, look at the chart of oil, look at the chart of nickel, look at the chart of, you can go through all of these and it's telling you that yes, it takes time to filter through, but basically that's peak inflation.
Right.
And that's why one of the reasons why I believe the markets came back off of their lows is because smart money said, all right, we can see for the past month, all these commodities have collapsed. That will filter through in the next month or so, and you probably have peak inflation now.
I want to ask you this. A lot of traders place bets ahead of data releases, so CPI, Fed minutes, company earnings is a popular one. Like, let's say Apple's releasing earnings tomorrow. I'm going to place a call option if I think they're going to beat earnings estimates. Do you do that?
I don't do that. And so let's talk about the options first. So understand that when you place an options trade before a big event, they are charging you a massive premium on that option trade. So basically, I have seen situations where, let's say you buy a call and Apple stock goes up $5. The call actually loses money, because there was such a big premium and now it's been sucked out because the event is over, that you need an even bigger move to make money. Now, in regards to big events like the Fed minutes or the Fed decision or anything like that, I don't do it because I have this strict criteria. Like, as a trader, you can't enter a position if you're a good trader or investor unless you analyze the charts and you say, I have an 80% or 75% chance of success. Well, how do you do that going into an economic number that no one knows? Unless you have insider information, right? There's no way you can say with 80% surety, I know this number, what it's gonna be. And so your odds aren't much more than 50-50 at that point. So for me, I don't play that stuff. I literally say, okay.
You don't do these option strategies where it's like you buy buy a call, you buy a put, you straddle, and then something happens.
I'm not smart enough for that. I just keep it super, super simple. I'm like, these are my 20 setups I look for. I look for multiple ones to kind of fit in a puzzle. And I take those, and that's how I kind of just keep it consistently making money in the markets. And again, I think it's important for people to realize is that always ask yourself, do I have an edge? Do I see something in the charts? And the charts are the only way I personally have an edge, is by reading them. It's giving me a little insight with a higher probability of what's going to actually play out. Aside from that, like a news release, I don't know for sure. Like, a lot of people with Ripple, they're like, oh, I think the judge is going to do this, so I'm going to buy. But really, how do you know with an 80% certainty what's going to happen? I don't think anyone does.
I'm going to read 2 more questions. They're very good, and then I'm going to wrap up.
Okay.
This one's from Utah Bigfoot. How will higher interest rate hikes help or hurt the economy? Let's just rephrase. So how will interest rate hikes help or hurt the economy?
So just by nature, interest rate hikes subtract the amount of money in the system, so they're going to slow things down. So the idea of why the Fed raises interest rates is because it does slow the economy down.
Right.
So they're fully aware and they're trying to do that because that will bring down inflation, right? If you slow the economy, people have less money to spend, therefore prices have to adjust down of goods so that people have that money to buy those goods, right? So number one, it's going to do that. Number two, keep in mind that I think we're coming up to a point where the interest rate hikes will actually come to an end. So I think whether it's 75 or 100 basis points in July, then you don't have a meeting for 2 months, and then you're pretty darn close to the elections.
Right.
And the Fed does not like to mess around. So I think there could still be maybe a quarter or 50 basis point in September, but my guess is then it stops until after the elections, and then by after the elections, the economy is so slow that they don't even dare do another rate hike.
You know, people assume, well, a lot of people assume that the interest rate hikes will actually bring down inflation. And so, in essence, you could argue that interest rate hikes could help the economy because they're making living standards better by reducing inflation in the long term. The premise, of course, is the assumption that they will actually indeed bring down inflation. Do you agree that it will help bring down inflation? Keep in mind now, some people have argued yes. Other people have argued no. The people who say no say, look, back in the 80s when we had another, boom and bust cycle, two double-dip recessions, right? Back in 80, 81, we also had double-digit inflation, and interest rates, the Fed funds rate went to 19%. But that's the point. Interest rates need to go at the level of inflation to bring inflation down. That's what they argue. Right now we're at what? Not even 2% interest rates. Right. And we've got 9% inflation.
Right. So I think there's a couple things. So number one, I do think that it will help bring down inflation a little bit.
Yeah.
But if it wasn't for some of the supply disruptions, I think that's been, so you have to look at it like, okay, well, what's the Fed printing of money attributing to the inflation rate? What's Russia contributing to the inflation rate? What's the supply chain disruptions? And so I think that's the bigger key, is when you finally get a resolution with Russia and Ukraine, when the supply chain comes back, it's going to naturally bring down inflation. The hiking of rates is going to bring down a certain amount as well. But I am not a believer that inflation is, for literally, it could be 10 years before we get back to 2% inflation. I don't see it. So I think that you're going to be in this back and forth where you have inflation that comes down, but because the economy slowed, unemployment goes up. Now the Fed says, oh my goodness, 10% unemployment. So now we have to print more. That means unemployment comes down, inflation goes up, and then they just go back and forth. But the problem is, again, you're never getting inflation back in the box. I mean, Pandora's box has been opened, and now we pay for it.
Last question, and I'll close off the discussion here. This one's from Alex. Please ask, can a swing trader get blindsided by a black swan, unexpected crash, and lose a lot of money? How does one protect themselves? In other words, do you hedge?
Yeah, so I think it's important to recognize that black swan events, there's not a whole lot you can do. I mean, my big fear is that you can't always hedge, because that's going to eat into your gains. By hedging, you're buying call options when you're short, or you're doing different things that are taking away from your overall gains. So what you need to do is you need to diversify. Right, I think that's the biggest thing. Like if a black swan event happens, maybe your stocks go down, but maybe at that point Bitcoin's low enough, Bitcoin rallies up, maybe gold rallies up. If you're diversified, that's the best hedge in the world. And again, so I'm not a big fan of like option strategies and stuff like that, but I do think you have to hedge by not going all in on one particular sector or like one coin or anything like that.
All right, well, that's all the time we have. This concludes the free trial, so to speak. But if you'd like to learn more, we have a partnership with Kitco Media does have a partnership with Gareth Soloway and the Better Traders. It's called the Winning Trader Series. It's a 3-part course that you can sign up for. And tell us about what people can learn from your course here. Yeah, so this is just an awesome partnership. I'm so honored to be with Kitco and the Better Traders to do this. But basically, it's about almost 20 hours of content, and I slaved away creating everything that I know and putting it in here, including the discipline side and how to become more disciplined, which I know is a huge thing that people struggle with, how to analyze social media in terms of understanding what the social kind of bias is and maybe thinking outside the box to go with the opposing side at the right point. So getting your emotions, analyzing the human psychology of trading, analyzing yourself. We talked about this as well earlier, about how to figure out when you're getting emotional and take a step outside of your body. And then ultimately it goes into, the setups of a winning trader. What are the setups that I look for on everyday charts that are high percentage, as well as the secrets. So things that I've come up with, like the confirmation signal, different strategies that have worked to make me the profitable trader that I have. It's all revealed in this 3-part series. So it's awesome, and I hope everyone does get a chance to check it out, because remember, the market's going to make you pay, and they're going to make you pay a lot more, or you have to look at learning. Education is number one. It literally changes your financial destiny. Again, you don't learn, you're going to struggle, you're going to give money to the markets. If you learn, your financial trajectory just starts to slope up and up with every little piece that you learn. So awesome stuff, David. Thank you for having me, and it's so cool to see you here. It's great that you're educating the public now. You mentioned to me way earlier when we first started, your parents were teachers. Yes. Yeah. Maybe that's had an influence on... My mom hated that I was going into the markets, by the way. She always wanted me to be a teacher. Well, so now you're going full circle. You're making money trading, and you're helping people trade. That's what it is. Maybe a Gareth Soloway University coming up? Maybe, if you want to run it. Sure. I'll be a guest presenter. Well, that's all the time we have. So thank you again, Gareth. Thank you. Wonderful to have you in studio. Wonderful. And real honor to be a partner with you. And thank you for watching our webinar today. Thank you, everybody who joined and submitted your questions. We couldn't go through all the questions today. There are so many. And I do apologize for the technical difficulties in the latter half of our segment. We had some sound issues, but if you're watching this on YouTube, it should be resolved. So thank you again, and thank you, Gareth. Thank you. I'm David Lin. Stay tuned for more.